discussion forward with Nuresh and Kunal, and Sunil Subramaniam is also here with us. Gentlemen, afternoon. Sunil, let me start with you. Mid cap, small cap got beaten out of shape between mid-Feb and mid-March. And I think we were discussing that when you were around last time. Many of them, more than 50% of the index was down 20 to 50%. You think the worst of that is over now in the small cap, mid cap, and value buying is emerging?
So I would put it like this, that see, so far from a pure earnings growth perspective, the mid and small caps have not disappointed. Okay, first point. Second is, with a strong economic growth, GDP numbers coming stronger and stronger, I think that the times ahead are good for mid and small caps, right? Now then, what was the cause for a correction at all for you to see whether there's a time to buy back? Right, I think that it was driven by, first of all, the correction was overdue, I would say, because so much liquidity was there chasing this good story, partly because of this whole SIP approach that distributors had taken to allocation to mid and small caps, that consistently every fund manager kept getting money flows. So they widened the basket. So what happens is that naturally, when you go for a quantity, quality tends to get diluted a bit. So a lot of stocks which got valued much higher than what a fundamental would show, right? Now, as long as the liquidity support continues, these higher valuations can continue. But that's when at the same time, because of these stocks and a whole lot outside the index also has gone up, like the penny stocks. So that's when SEBI's caution to the fund managers. Remember, SEBI just spoke about the froth. They didn't say anything about the retail investor directly, but they asked the mutual funds to take some action to ensure adequate liquidity in their portfolios. Now, that news was then to be made public by mid-March. And so there was uncertainty around that. And fund managers naturally also probably tried to answer SEBI by saying we have enough liquidity, though there was probably some selling in small and mid caps which had run up a lot, and that would have moved to large caps. So this was a trigger of liquidity suddenly getting a little bit slowed down because of that situation. Now the SIP book continues and there's buying. And so that's why if you see the correction, though it happened in that 1 month, it can't sustain, because every month fund managers, out of the 19,000 crore SIP book, 8.5 to 9,000 crores is in small and mid caps. So that buying power will contain. So the point is, I would say, is that going forward, two things. One is the quality stocks, even if they are slightly higher valued, will continue to get more buying. But there could be a separation of the dust from the chaff, as they say. And so you would see some amount of selling pressure in the perceived lesser quality stocks, or those which went up purely because of liquidity. Now, so I would say that this divergence will continue. So good quality mid and small caps will continue to get superior valuations because the anticipation of a better earnings growth cycle. So then come April 10th onwards, when the new earnings cycle starts, is when the reevaluation will start. And so from mid-April to mid-May, you will see the earnings cycle play out, and they will see how these companies are stacking up vis-a-vis what each one had projected. And if those numbers actually come out better, you could see better buying come up. So I would say that the continuing liquidity support and the fact that the liquidity data that was released about mutual funds was by and large comforting. There was no cause for anybody to worry. There's no panic situation as far as mutual fund holding of small and mid and small cap. They have adequate liquidity and adequate, and the concentration risks are well managed. So I would say that it was a storm which was partly a result of excess liquidity coming into this segment. Things have now, dust has settled. A lot of stocks which went up a lot have corrected a lot too. So now I would say, but still for the next another 15-20 days, till the earnings cycle starts, it would still be a more stock specific, wait and watch, observe the whole thing go. But once the results come out and you get a reinforcement of the earnings growth of specific companies in the mid and small cap, people will go and buy them, because we are talking about at least a 3 to 5 to 7 year long business cycle. And mind you, we are in a situation where private capex has really not started yet. So if that starts, all these mid and small cap suppliers to that. So I expect the cap good story and those stories to have a sustainable growth path. So I don't see that from a medium term allocation to mid and small cap, especially through mutual funds, there's any cause for worry. SIPs and STPs, as always, should be the better way to acquire mid and small cap because naturally they are inherently more volatile. So when you do an SIP route, rupee cost averaging comes to your benefit. So I think
Absolutely, Sunil.
that's the way.
That's your take on the broader markets. At least for now, you believe that the storm has passed and the dust is settled. But Kunal, does that seem to be the case? Do you think that the storm has passed when you talk about the broader markets in particular? Also, Kunal, I was just checking the data when you talk about the sectoral indices. And one sector that actually stood out was the realty index, right? It was a star performer over the last 1 year or so. In the last 4 trading sessions alone, 7% up move come in the realty index. Do you see this one also now trying to be one of the sectoral leaders?
Well, yeah, looks like, I think so. The sheen which had gone off for the real estate stocks, I think would probably have made a strong comeback. So, and I think what I like about the move this time around for real estate stocks, that we are not too much dependent on the, the 2 or 3 names which were the leaders first. So, for example, DLF was one of the prime movers which managed to lead the rally, and then there was a slew of other performers which managed to chug along. But then you look at the last 10-15 days of price performance, specifically from the mid of March when the bottom formed for the mid caps and the small cap index. That's where you see a class, a complete differentiation in terms of the outcome for the real estate stocks. Oberoi Realty is one of the stronger names which has emerged as a trend reversal as well as a recovery stock from the real estate pack. DLF has also managed to move up higher by a margin of I think 8 to 9% approximately. Then you have Prestige, Sobha. These stocks have also managed to chug along quite well. So I think it's now the leaders for the recovery for the real estate stocks that have changed, and I think that's a positive sign for the index as such.
Right. Well, the one positive mover for the index, which is surely doing its magic, has been Reliance Industries. In fact, we'll get you more details on what the Goldman note actually has to say about RIL, but they've maintained a buy. They've upped the target price all the way to 3,400. Naresh, on the charts, what's the reading? It's almost closing in on 3K already, but when do we see a meaningful move all the way to 3,400 in your view?
So technically the setup is there. If we look at the recent highs, we made almost 5 to 6 attempts around that 3,000 mark where the stock stalled and corrected down to 28.25. Today also we've come close to that 3,000 mark. Sustaining 3,020 would actually open up a target price of 3,300, 3,400 in a short to medium term. So the structure is there. Today's price volume action is very positive. So going forward, it becomes a buy on dips stock also, and at current levels also looks interesting. I would have a target price of 3,300, 3,400 in the short to medium.
You have to tell us exactly about what the Goldman Sachs note on RIL is and what gives them conviction that the stock is going to climb up all the way to 3,400.
Well, for Reliance Industries, if you see, the important point to note here is that this is the second big target price hike that has come in from a foreign brokerage in less than 1 week. Now, earlier it was UBS which had increased the target price on Reliance Industries to 3,420, and today Goldman Sachs has increased the target price on Reliance Industries to 3,400, which is a 16% hike. Now, the reason why Goldman Sachs has hiked the target price is because they are believing that the capital expenditure cycle of Reliance Industries has peaked, and going forward, the capital expenditure, whatever Reliance Industries will be doing, will be for short gestation period, which means that the capex to EBITDA turnaround will be much faster for Reliance Industries going forward, and hence for such a big company like Reliance Industries, they are still expecting that EBITDA to grow at a CAGR of nearly 17% over FY24 to FY27. Now, given the fact that capital expenditure has peaked, the brokerage is also expecting the company's return ratios to expand going forward. And in past, we have seen a rally in share prices of Reliance Industries only in only two times, and that is one when the return ratios of the company expand, and second is when the company goes ahead and does some dilution in their stake sales and raise much more funds. So both these factors are the key catalysts for Reliance Industries, and one of them is expected to happen soon, and hence Goldman Sachs has upgraded the target price, and they are saying that if going forward Reliance Industries goes ahead and does some stake sale and does some monetization of its assets, then again that could trigger a fresh rally in the share price of Reliance Industries. And at this moment they are saying that the risk reward is also favorable, given the fact that despite the 23%, 26% rally that we have seen in the last 6 months, the valuations are not expensive. They are at par with their historical averages for Reliance Industries.
Thank you for for that, Soumit, for exactly outlining what Goldman Sachs has to say for Reliance Industries being among the top gainers on the Nifty, aiding the Nifty in today's rally at least. But on that note, we slip into a break on this edition of Closing Trades. When we come back, there's lots more stocks to discuss about, lots more news to cover. Don't go anywhere.
All right, let's move on and also put the spotlight on names which are buzzing with high volumes in today's session. Ansh is joining us for more on that. Ansh?
Right, so we'll start with STDM first. Stock seems to have given a breakdown from its upward sloping channel with volume of over 23 times its 10-session average volume, and it has also touched 2-month low level as well. Apart from this, ABB India will be in focus as the stock has touched record high level with volume of over 2.5 times its 10-session average volume, and it has formed higher highs for 5th consecutive month. Lastly, Info Edge will be in focus as stock has given a good breakout from its falling wedge chart pattern with volumes of over 2 times its 10-session average volume, and it also trades above key DMA levels. So keep an eye on the stocks.
We'll get back to you because we also want to take stock of how D Street's performance has been in FY24 with you. We'll just get back to that. But in terms of the volume movers, ABB clearly is right on top there. About a 6% notch up coming in on this one. Of course, there was a brokerage note as well coming in, right, Ajay, this morning on ABB?
Yeah, that's correct. There's a major upgrade which has come in, and this is actually, in line with what's happening in the capital. Remember, just a while back, Cummins India management came out with a very massive upgrade for their business outlook, and the stock ran up almost 7-8% that day. We even interacted with the management. Now ABB, UBS believes that despite of the slightly higher valuations, it's a very integrated kind of a play as far as the electrification of the Indian ecosystem is concerned. And the new target is almost 30-40% higher, and that is powering. Look, it's an FNO stock, by the way. So that's something to watch out for. Kunal, how's the volume? Is the move coming in on the back of fresh long position addition, and what's the data looking like in ABB, if you can check for us?
So the volumes are good, but they're not great enough because the bigger chunk of volumes for ABB actually happened in the mid of Feb. That was a point when the stock had clocked, I think, 45 lakhs in terms of daily volumes, 2 consecutive days, and on that day, I think the stock moved from 4,500 to I think 5,500 in just 2 days. So almost a 20% move was seen on the back of some extremely high volumes for the stock. Today's volume so far is just about some 10 lakh, 11 lakhs on the NSE. So that itself tells you that it's a rise on slight lower volumes, but then, this is what typically happens, that a big buyer enters into the stock at a much lower level, and then once the stock moves up higher by a margin of 20%, it just adds to the cushion price for the stock.
Sunil, I just wanted to understand, how is it that you think one should now capture in on this entire electrification theme which is playing out currently, and I mean the larger capital goods umbrella? Sunil?
Yes, I think the best way is to put into diversified funds. I think it's largely the power sector story is a mid and small cap story, right? So one option is to go in for power sector funds. But I would say because there's the extreme cyclicality, people may not know when to book profits and to move out. So better to rely on a bunch of large and mid cap and multi cap, and and with a little bit of small cap and mid cap in the portfolio, because most of the fund managers are positioning their portfolios with a heavy tilt towards capital goods, especially with the longer end of the curve. So I think the quality selection of these stocks, what is the right price to buy them, when do you book profits, is best left to the fund manager. The second aspect is, given the fact that that's a volatile sector, right? SIPs and STPs would be the best option. So I would say stick to multi-caps broadly as a category. You will get your adequate exposure to power, and to the extent possible, you stagger your investments over the next few months, because it is truly a long-term story. And hence, for you to reap the rewards, you keep buying on dips, which again, when you give an SIP to a fund manager, he will choose the right prices to buy, which is effectively to buy on dips. So I would say, no, rather than venture into your own saying this power company will do better than that, and this is the right price, I would say leave it to the expertise of any fund manager for that.
Ansh, in fact, is waiting by to tell us how FY24 has been for D Street. So let's take stock with Ansh once again. Ansh?
Right, so this financial year, Nifty, Nifty Mid Cap, Nifty Small Cap, all three registered its biggest single financial year gain in over 20 years. Also, all indices touched record high levels as well. Nifty gains around 27%, having Tata Motors, Bajaj Auto being the top gainers, gaining by around more than 130%. Losers are only UPL, HUL and HDFC Bank in Nifty index. But if you talk about other broad indices, both mid cap and small cap are also in green. They are up by around 60 and 69% respectively, and around 90% of both mid cap and small cap stocks are in green, with 20% stock delivering return more than 100%. Let's shift our focus to sectoral indices as well. And here we are seeing Nifty Realty as the top sectoral gainer. It even touched record high level this financial year. Actually, all indices touched record high level except for Nifty IT index. Now here we'll see that Nifty PSU Bank index is advancing for fourth consecutive financial year, gaining more than 85%, whereas Nifty Bank 2 advances for fourth consecutive session. Let's also talk about market cap. And here we are seeing India's market cap for stocks in FY24 has increased by around 123 lakh crore, out of which Reliance, Bharti Airtel, TCS and LIC and Tata Motors have contributed the most by around 13 lakh crore, which is more than 10% of the total market cap addition. So overall, this FI is marking a history by showing us moves not seen in decades.
Right, Ansh. Thank you for taking us through all the winners and the losers in the year, or the fiscal year of FY24. Coming to you, Nuresh, and in that, definitely one of the top losers was HDFC Bank. Do you think FY25 or at the start, once you start FY25, things will look better for HDFC Bank in particular? Because I'm sure a lot of them have been waiting for this one to turn around, and the turnaround has not taken place at all.
Interesting times for HDFC Bank, and if we look at price action, one difference of late has been the stock has stopped around that 1350, 1400 mark. It does not correct sharply. And if we go back to the history of the last 4 years, pre-COVID, the stock used to have a top around 1300. Post that in 2021, it made a bottom around 1350. Then post the merger, pre-merger, bottoms are around 1300, 1350. Very recently, we made a bottom around 1350 levels. So out here at 1430 odd levels, you have a stop loss below 1350. And if this is making a turnaround, it could go all the way back to 1600, 1700. So the risk reward is in play. Price action would confirm if it sustains about 1470 odd levels. But looks like the next year could be better for HDFC Bank compared to the last 3-4 years.
Right. Sunil, I want to talk to you about a sector which perhaps you understand so well, because you've spent almost upwards of 25 years in that sector, asset management. A bunch of companies are now available. Even some of the wealth management companies pull up how Nuvama is actually trading in today's session, almost 12%, big breakout. But there are a bunch of other AMCs, Prudent is there, wealth management companies are there. I want to talk to you about not these stocks, but the there is one section of the market which believes, I remember when we were chatting, SIP figures had crossed about 15,000 crore. Now it's knocking on 20,000 crore number. Does it appear structural to you? And either wealth management companies or AMCs or some other market infrastructure kind of stocks should be there in the portfolio. Do you have that visibility?
No, absolutely. See, this 19,000 is also, I believe that this could double in a year's time. See, what's happening to the mutual fund? Today, you have just 3.5 crore folios in mutual funds out of a 140 crore population. India's mutual fund assets as a percentage of GDP, as a percentage of household savings are all in the single digit, maybe low double digit in some particular pockets, right? And you have a situation where I think I saw some recent data which said that 10% of the country's population controls 75% of the nation's wealth. Now, it's such a concentration. So on a 140 crore, you have 14 crore people who have 10% of the nation's wealth. Now, that amount of money, right? Now, what's going to happen? Yes, they can spend that money, but how much can you spend? How many houses will you buy? How many fancy cars will you buy? So at some point of time, it has to filter into the savings bucket. And when people are wealthy, right, they're not satisfied with just a steady rate of return from a bank deposit. They know that they have earned their money. They know that they are more than adequate to keep their lifestyles going for the next 50 years. So they want to capitalize on opportunities, right? So some of them go into AIFs and high-end PMSs. But if you see there, a core part of it is filtering in as an alternative to bank deposits. Now, just around 2010, I think, right, the mutual fund deposits as a percentage of the banking system was just 13.5%. Today, that number has touched 27%, which means doubled. But you still take it in comparison to the United States or any developed market, is still way below. So I think that the mutual fund industry, along with its wealth management arms, like, you mentioned a few companies there, those which have direct access to customers, have a phenomenal glide path ahead of them just from the penetration story. And the fact that, bank deposits, ultimately don't beat inflation. That's a fact that everybody knows and realizes. It's just that the regularity of the income is smoothing. But you're already seeing banks under pressure on the CASA, on the deposit front, because they are beginning to lose money to mutual funds from their depositors. And the fact that banks themselves are among the largest distributors. So what they are themselves doing is, in order to keep their customers happy, they're also shifting away from deposits into these mutual fund related products, right? AIF, PMS and mutual funds of their customers' money. So the fact is that this is an inexorable rise, right? And I see the penetration story and this rising at a much double the probably the nominal GDP growth rate will be the growth of the overall wealth management space, where mutual fund asset managers as well as wealth managers, for distribution firms, all of them will have a part to play. So I think that these are the core story of the Indian economy, the savings potential. And let's not miss the fact that as a country, right, the financing of our growth story, the capital market has to play a big part. So the government also, I see, that will be nudging and encouraging this, because banks can't be financing our entire growth. Then you inevitably go through this cycle of super rapid growth, cycle of NPAs back again. The capital markets are much more efficient distributors of capital, and they know when to give it and when to take it back. So I think that the country itself in its growth path has to get the capital markets more as a part of the financing of our country's growth rate. So I think that this overall story on the savings side, right? I would say savings as a broader basket, it's actually an investment side, right? It's a long-term structural story as the penetration. That's where the whole distribution network, the air efforts in promoting SIP, the AMFIs with this mutual fund Sahi campaign. Now, our companies also run an SIP Sahi campaign. Things are promoting the penetration in such a rapid manner that I would say we are going to be, doubling it in every 4 to 5 years, I would say.
Absolutely. Great having you, Sunil, and great, getting all that perspective from you as always.
Thank you.
Okay, on that note, we're going to take a